Now we're going to look at securities with option-like features. Some financial tools are very similar to options. The first we're going to look at are warrants. Warrants are puts or calls written by a company on its stock. Warrants are meant to make a company's stock more attractive to investors, or to act as a bonus for employees. Warrants differ from options in the following ways. Warrants have a longer life, 5 or more years, possibly without expiration. When warrants are initially issued, they are out of the money. That is to say that the strike price for calls on warrants is greater than the current market value of the underlying asset, or the strike is lower in the case of puts. Warrants grant the right to purchase or sell one share of stock only, unlike the 100 shares covered by options contracts. And warrants are unaffected by splits and dividends. Finally, wherein the number of options contracts issued is dependent upon demand, the number of warrants issued is always fixed and limited. The next we're going to look at are rights. Rights are yet another form of financial instrument. In general, rights allow shareholders to purchase new shares of common stock prior to their public issuance at a price below the market value of their outstanding shares. Unlike warrants, rights have a very short lifespan, approximately 2 to 10 weeks from the day of issue. During this period, a company's stock, which is already on the open market, is sold cum rights, or with rights. That is to say, an investor who owns or purchases stock at this time gains the right to purchase a number of as yet unissued shares. Once issued, rights can be sold on the market without having to sell their associated shares of stock. The initial prices for rights are derived from a mathematical formula, after which their price is determined by the factors of supply and demand. After the X rights date, the date after which the outstanding shares no longer have the attached rights, stock is bought and sold as normal with a reduced price. The reduction in price is equivalent to the price of one right. Convertible securities are financial instruments which can be converted into other securities of the same issuer. The most widespread convertible securities are bonds and preferred stock, which can both be changed into common stock. In order to do the conversion, it's necessary to know the conversion ratio. For example, if the conversion ratio is 100, it means that we can exchange, let's say, one convertible bond for 100 shares of common stock. As a rule, at the moment of issuance, the conversion ratio prevents investors from generating a profit by making an immediate conversion. Instead, they must wait until the common stock appreciates to a certain level. This feature makes convertible securities look very similar to warrants, whose strike, at the moment of their issuance, is out of the money.